My name is Jeff Zipper. I will be the moderator. I am with Fifth Third Private Bank. And for those who don't know, and Marty had asked me when I came in this morning, because we've known each other quite some time, you know, where is Fifth Third Private, where's Fifth Third Bank? So I'm with the private bank, but Fifth Third is a retail bank, a regional bank based out of Cincinnati. Anywhere between 10 to 14 as far as size goes, depending on the day. There's a lot of congestion, assets under management in that space, but we are rapidly growing in all parts of the business, and that's retail, where I am private banking, commercial. Just to give you an idea of the retail bank, there's currently about 125 branches here in Florida. In the next 12 to 18 months, there'll be double that amount. So the bank is growing quite a bit in all lines of business. And for those that in here that follow public markets, I know the specialty is private, but the stock price is up 42% this year. I know that financials have been one of the strongest sectors, but that performance is still double the Dow Industrial Average and much better than the S&P 500. So with that, I am going to start with Richard and go down the line so you can all introduce yourselves and tell the audience what you do.
Thank you. So I'm Rick Stone. I have my own family office, and then I'm also the head of the Palm Beach Investment Research Group, which is a group of 35 family offices that meet twice a month to vet investment ideas. We invest individually, but we do due diligence as a group. We've been in existence for 15 years. I've seen 800 managers in that time period, all in the private space. We do not look at deals that are sold by banks or investment banks. They're our friends and we're not their competitors. So we're looking at smaller managers, niche spaces, all the alternative space.
Well, obviously you've heard from me before, but just want to add, I'm also an advisor for the Latin American Family Office Society, which we created about a year ago here in Miami. Hopefully that, as we all know, Miami is the gateway to Latin America. So it's a mission that we've been working on to bring a little bit more continuity and power of the Latin American families here in the US. With regards to investing in deals, we have homes in Brazil, we have homes here in the US. So generally we focus on investing in deals in the US and in Brazil, although we invest more internationally, as I mentioned, in Europe. But I think it's important when you're investing in deals to do it locally because it's more time intensive and you have to look at more details. It's easier to invest in new areas and funds globally. You don't have to put as much attention as you do in deals. So we focus on our deals generally here in the US and in Brazil.
Sal?
Hey, I am Sal Buscemi, originally from New York. I met Marty 15 years ago after leaving Goldman Sachs, and I've been following him like the Grateful Dead ever since. He's been a tremendous resource, and he's really helped us out. I am the co-founder and managing partner of Brahmin Partners, which is a multi-family office of about 13 families, and then some other people who have followed me since leaving Goldman and meeting them as we've gone into other things outside of real estate. Currently, we have a portfolio of about 15 very strong names. In venture, we do some higher profile things too. Recently, I don't know if many of you saw the news that came out last night. We were at dinner, and SpaceX came out with a $350 billion valuation. Last night on Monday Night Football, another one of our portfolio companies called AI Scout. Actually, that was this morning, it was announced with the Saudi PIF fund. They're in collaboration, so I'm pretty happy about that. And on Monday Night Football, I didn't see it because I was busy here, and then also we had Marty's dinner. Another one of our portfolio companies, IvyFON Solutions, is actually mentioned on Monday Night Football with a player by the name of Ward, I can't remember, but a lot of these companies and the diagnostics and a lot of the therapeutic companies we've invested into have really performed well. We had one exit so far this year. We're expecting another one later at the end of this year. And we have a very tight culture, and a culture of interactivity and only going towards the best managers.
Thanks, Sal. I'm going to start on this end with Richard again. So with the uncertainty of the election behind us and Trump 2.0 do you see any impact, whether it be negative or positive, on policies with the Republican sweep, Trump 2.0, and we keep hearing about deregulation, part of his new policies?
Well, I think it's difficult to predict what the Trump administration is going to bring. I think some of his policies lead me to believe that rates are not going to go down, stay where they are, plus or minus 50 basis points. So that's possibly a negative because I think a lot of people were anticipating lower rates. I think the regulation bent should help merger arb and merger transactions, because there's been a bias of the FTC and the Justice Department to challenge a lot of vertical deals, and those deals have been waiting to get done. So I think merger arb, which has sort of had a tough slog, there's a couple of deals that have blown up, and fewer deals should do better in this marketplace. Other than that, it's difficult to predict what will happen because the market's been so focused on a few names and on the potential for lower rates. It's unclear whether or not he will actually increase tariffs or if he's just threatening to increase tariffs to gain leverage and what that will mean overall. But I don't think that his presidency is going to change the market dramatically. We're in the aftermath of the largest liquidity event in the history of mankind, which is the $7 to $10 trillion that were put in the market during COVID and thereafter. And we're living now with the wealth effect as a result of that. A lot of that money was put into the stock market and into hard assets. So we have a asset bubble in those areas. We have stocks trading at 300 times earnings that are large cap stocks. We've never had that phenomenon before. We have a market that's more than double the European PE and triple Asian PEs. So we have asset inflation, and I don't think that will change under Trump. It will change at some point, but I don't see it changing in the next 2, 3, or 4 years.
So I think we have a situation where we have some conflicts with Trump in terms of what he's going to do. Give you an example, Elon Musk, I think, is pro-climate, pro-EVs, climate tech, yet Trump, in theory, is not. So I don't know how that's going to end when they sit down and have a coffee together. We shall see. What I try to do is try not to get caught up in the day-to-day. We're long-term investors. Generally, when we invest in funds, or especially on the early stage venture growth capital, these are 7 to 10 year plays. So we look at trends, we look at companies, we look at executives, how they do well, and we focus on that. What I have seen, though, in the last 18 months, generally valuations have, in the Series B, Series A, where we focus most of our investments in directs, valuations have come down over the last 12 months. So that's been a positive. We've been able, it's an interesting phenomenon when you're sitting down. There's obviously the bit of FOMO that people don't want to miss out, and then there's FUD, right? Where people just, if a company comes back, it's amazing to see 40-50% haircut to valuation 6 months ago. It is amazing how people generally will not do the deal. But we look at it, we back the manager, and we think it's a good manager, it makes sense. But it's hard emotionally and mentally to do that. So we really try to be objective on that basis. The other thing that we've done, sometimes the macro headlines, economics, don't make a lot of sense. And I'll give you an example. I think as a consensus, most people here would say that Europe is not doing as well as the US. We heard one of our speakers yesterday say, I think the average growth may be 1%. Europe's been in relative decline for 30 years, right? I think we all agree on that. However, we've invested recently in deals and a climate tech fund and doing deals with that. Because if you go to Europe is far ahead of the United States with climate tech. We just did deals, pan-regional fund, looking at infrastructure, very nice risk-reward ratio. You go to Scandinavia, you go to Germany, you go to the Baltics, even the UK are miles ahead in general than the US. So I think we all get caught up a little bit in the headlines, but it's digging down and looking more what's really going on the company level. And then you can find better opportunities, and we look at comparisons of price points. And I think good companies these days are going more global. If they start in the US, they start in India, they start in Singapore, they certainly are looking globally, especially with smaller countries like Singapore, Netherlands, Israel. They focus from day one, looking international very, very quickly. So I think the key is to try and dig through some of the noise, dig further down from some of the macro levels, and then you can find better opportunities.
Thoughts, Trump 2.0?
I think technically you can get into the weeds and, you can sort of try to figure out where interest rates are gonna be. However, pragmatically speaking, I was recently at Reid Hoffman's event, Albert and I and my partner were invited to, and the euphoria around technology reminds me a lot about, the IPO days when I was coming into age of Goldman, even though I wasn't in that group. And I think what you're seeing right now is that 2025 is probably gonna be one of the best banner years ever for IPOs. And 2026. We were joining a dinner last night with some of our SpaceX investors, who might be in the room. How fast is Elon Musk going to get that S1 filed after Inauguration Day? And I think there's been a buildup of looking for this, and with all the technologies that's coming today, America, I think, is starting its next great era. Will that start immediately? Probably not. I agree with Richard. Probably 2 years to get through some stuff. But the economy's also been pretty. We haven't had any bank blowups other than really Silicon Valley banks. So everything's been kind of constrained at this point. There weren't really many issues. Yeah, there's all multifamily and issues related to bridge debt, but the economy has been pretty strong, and I think it's going to be a good linchpin going forward for what I think will probably be the best markets ever for the next 2 years. Public markets.
Let's say here, next question, you discussed SpaceX. What deals do you find interesting right now?
We love diagnostics, we love healthcare, we love healthcare technology. We did invest in the Stripe, which is great. We have one company that I spoke of earlier, which was a pure AI play, and that's worked out really, really well, called AI Scout, which is recently rebranded to AI.io. But we really like it where you're trying to take over, build really a following using a new technology. We are big fans of Tom Forrest-Porsche. I don't know if he's in the room, or he's over there. We like that because, he's basically, reinventing the microscope, right? I mean, for the first time in 100 years. So that's pretty impressive, and especially in our environment today where people are focusing on longevity, they're focusing on all sorts of these things. It's the kind of technologies we like to be around and really makes us happy. It makes our investors very happy too as well.
Same question. What kind of deals do you find interesting right now?
So interesting enough, about 6 years ago, we invested with Tom, and about 6 years ago, we invested in SpaceX, so very different type of companies, right? But I guess one of the deals we've done more recently on the larger side was CoreWeave. So if you put CoreWeave is basically focused on cloud, and NVIDIA is one of the biggest clients as also investors. There is, I think, a tremendous amount of necessity in the next couple of years about power energy. If you look at what's going on, there's going to be a shortage of power, and how are we going to resolve that? Well, the U.S. grid is per se, it's old, it's archaic, it's not self-sufficient. Yes, alternative energy is important for sure, but that's not only going to be the only solution. So one of the things that we're digging in more recently is looking at not only on the early stage, but a little bit later, how we can go into the power, how we can solve that issue going forward. We had mentioned before in terms of climate tech. So we're investing, I'll do a little plug for my son. He's at Stanford doing a master's in renewable energy, basically. So we're spending a lot of time with other family offices in the region. And there's this tremendous amount of new ideas. And whenever I go to universities, I get very optimistic. As I turn off the news and I think about the future. And whether it's Stanford, whether it's the good schools here on the East Coast, etc., there are many innovations happening. And we try and we do a lot of seed investments as well, because we like to, obviously, those seed investments, they don't have as much in terms of percentage of success, but you only need 1 or 2 to pay for it. And unfortunately, that's been the way to do it. So that gives us also a pipeline of the future. And then we look at how we can do that along the different stages. So we generally look at trends, and then we look at stages and how we can invest. And obviously the check size is much smaller investing in a seed than a larger deal, but that's a way for us to get to know the sectors better. And then we go dig in and continue to go up the food chain from the seed to Series A to Series B to sometimes Series C to invest. That's how we did Space Tech, for example. We invested in a couple of companies. Some of them failed, but it got us very much more knowledgeable about that. Same thing with CoreWeave, with the AI, with the cloud. We investigated early, made a few mistakes on the early stage, but then when we were ready to give a larger check, we had learned about it.
So we don't do any startups or A rounds or B rounds. We're typically allocating larger amounts of money to managers. The spaces that we like now are merger arb. I think there's going to be a lot of merger activity. It's been held back. We still like private debt. You can still do 10, 11, 12% of private debt at a low risk phenomena. We like merchant finance, which is where you're financing local businesses, which is a 20% business managed correctly. We're doing a lot of co-invest on deals. We're trying not to go long because between now and then, whenever then is, there's going to be a market break. The debt wall, the asset bubble will break between now and the end of your next PE deal. As I told students I teach at FAU, I said, I still own partnerships that were started by Lehman Brothers. And I'm pretty sure they will outlive me because they run them and generate fees each year and pay themselves fees in lieu of a distribution. And these are deals that were from 2006 and have never paid out a penny. And you can have that kind of phenomena when you have a market break, as we did in 2008. And I think we will before the next 12-year deal gets done. We like litigation finance in certain areas where it's more factoring than speculative litigation finance. There's lots of deals that are already done on the litigation front. I'm a lawyer where the people are waiting for money 16, 18, 24 months, and you can finance that at high teens with the security of the collateral of the case itself. We're looking at India quite seriously. The Indian IPO market's on fire. They're relatively small deals. They're hard to get into. It's very hard to become an individual investor in India, and there really aren't funds. But if you take the time and effort to do that, that's a very good business. And it will continue to be because India is going to continue to have growth. And the way they raise money is by doing $2 to $5 million IPOs. They don't have an established debt market. They don't have pipe deals. They do small IPOs. We like pipe deals also. There's a lot of people in that market space, but NASDAQ companies like the tech companies and biotech companies, they're talking about burn through their money and they need to do pipe deals to keep going. And there's more and more of those companies. So if you have a good manager in the pipe space, you can also do mid to high teens. Some of the deals will fail, but very few in the end fail because you own the stock. Unless the company fails, you don't fail. In terms of power, most power deals are take or pay contracts. So the take or pay contracts in the last version were 12% on average. They're going to go to 14 to 16% because of the need for more energy. And we're going to do a lot of those power deals in the future. And there's a few established players in that marketplace. One of them is Harvard. And we're going to do the next series of deals, which I think will be 14 to 16%. They're take or pay contracts, so unless the company that's generating the electricity and its providers, which are municipalities, go out of business, you get paid. And they're typically 10-year deals. So you're doing 2.5x with a very, very secure credit. That's what we're looking at.
I'm gonna stay here with you, Richard. So you brought up some really good points. 2 questions ago regarding valuations in public markets. So can you expand on the public versus private and the valuation discrepancies and why maybe private makes sense going into 2025? And we also heard in a previous panel about fixed income where you could get, if you're in a 52% tax bracket, you're getting close to 10% immunity. So I just wanted to talk about, valuations, public versus private, and what you see there.
Yeah, I heard that muni thing. I think it's off by about 300 basis points. There are 5% muni deals that are secure. Hamilton College might issue 5% for a small, piece of muni, but and nobody's paying 50% taxes, they're paying 40% tax in Florida, 38, 39, so it's more like 7%, which isn't a terrible return, but it's not 10. I think it's very difficult, the question you're asking. I mean, I think, in a minority of people that think we are in a true asset bubble that's unprecedented. It's a United States phenomena, and maybe there is American exceptionalism. I do my son's homework in school, and he's always telling me about American exceptionalism, but he's talking about the Declaration of Independence, not multiples of 300. And it's hard for me to understand people who say the new Trump era is going to be a boom in marketplace PEs, because we've had that boom. And so we have shied away from participating in the Mag 7 to our detriment. We did think the Russell was undervalued, and it had come nowhere near all-time highs. In fact, it was 40% off. So we did trades around the Russell, and we were right. Not because Trump, the Russell was moving before Trump. The small banks and mid-sized banks were also moving because they suffered the Silicon Valley effect. And then after that dissipated, they all moved up to closer to book, 1.2 times book. So those were trades that made sense based upon historic economics. The current marketplace doesn't make sense to us based upon historic economics. And we're concerned about a market break much bigger than 2008, much bigger than 1999, because we have individual companies that if you took 50% off their marketplace would be $100 billion. We've seen a bunch of deals fail that came public that had 10 and $20 billion marketplaces, market valuations that were worth zero. So we are seeing some of that happen. But the main takeaway I would give is that investing long-term now in a traditional PE fund or in the evergreen PE fund, which is the flavor of the week, I think is treacherous, because between now and 12 or 15 years from now, when that fund is about to pay out its final dollars, there's going to be a monumental market break. And it's either going to extend the life of your fund by 5 years or result in very poor returns. So while other people think this is a great vintage, I would disagree substantially.
Can I just bring up one point, Rick, that kind of supports some of your argument? Is that, having lived through Trump, is that when Trump was president, we only averaged 170 IPOs a year. I mean, it was 90 last year, which is not great, but.
You know, what I think is fun is when we have a little disagreement on our panel. So I'm gonna disagree with my esteemed panelists here. We've been doing investments since 2001. So just a comment about the Trump bump that we've seen. I think if you look at the S&P, et cetera, it moved less this time. And that was because the public markets were very historically expensive. So if you go back to his last election, and we had a presentation yesterday, in the S&P and the Russell, except there was much less of a Trump bump. And so I certainly agree on that angle with the fact that the public markets are at a historical high. Now, I am a family office, so I look at the mirror, and sometimes I feel I'm very smart, sometimes I feel I'm very stupid. So we found it too difficult. I've been investing in venture capital in private markets since 2001. There's a few cycles in there. So if you find the good managers, if you find the good deals, they pay for themselves. You do well. I'm very fortunate that I've had a good track record in terms of that. Where I think I'm not good at, and I took a bit of an extreme view 2 or 3 years ago, I basically sold all of our public markets. So have I missed the boom? I have. But I don't think it's that easy to figure out. There's a lot of speculation in the public markets. There's less fundamentals than when I was an analyst many, many years ago at Morgan Stanley. So perhaps for that reason, I feel that the consistency and the returns on the private markets make sense. And because of that, I think that if you're with a good manager, and I mean, I have almost 25 years experience in different cycles, the private markets on a risk reward basis, if you can handle the less liquidity, which is a question mark, right? But if you can handle that, if you can allocate, there has been a consistent, if you look at the large PE firms, the largest private equity firms, 40-year track record, 400 to 500 basis points over the S&P. We don't, with a small sliver, as we consider it, leveraged beta, that for me was our substitute, the S&P. So we took that and said the S&P was overrated. So we're getting 400 to 500 basis points over the S&P investing in that. So it's almost a synthetic play on the public market. And then we went down on the private market, the smaller, as I said, to venture the growth capital. We're getting much better returns consistently over 20 years. So I don't worry so much about the market this year. We've been investing for 25 years, and hopefully I'll still be around in 25 years, and we'll continue to invest in that. And if you pick the right managers, you pick the right cycles, pick the right companies, then it's almost less of an issue, and you continue to do well. So that's, we prefer much more private over public for those reasons.
Thanks. Thoughts,
I think if you're looking today, like a lot of the things that are trading, especially when we look at it in secondary market, like when we got into strike, you're getting information, right? So you can see a lot of these public companies that, these private companies trading like public companies, because of, the secondary market, which is kind of interesting when you look at it. But we do not really play in the, in the public markets at all. And, I agree on a lot of things that Rick and the other gentleman was talking about, but I also think that there's going to be a lot of animal sentiments, and the lowest barrier to entry for everyone to get into is going to be the public markets, right? And that's where you're going to start, I think, to see like a lot of like issuance, right? It's not necessarily going to knock any records out of the park, but I think you'll see valuations continue to go up because that liquidity will go somewhere.
I'm gonna stay here for the next question. So we have a FOMC meeting coming up in a few weeks. Futures are pricing in pretty much another 25 basis point reduction in rates. Your thoughts on the Fed and any effect going into 2025 on any of the deals that you're looking at?
We're actually looking at Class A industrial right now. That's sort of like our mainstay in real estate. I really like it. But I think rate cuts right now, I think they're more optional than necessary, unless there's other things going on underneath the surface we don't know about.
Thoughts?
Questions?
Can I just ask a question on the, can you guys address, do you think the public and private markets are going to correlate more given interval funds and evergreen funds and secondary markets and higher valuations for larger private enterprise like SpaceX compared to larger public multiples like the next 7? Like, are we going to get higher correlation with cost diversification in the next 5 to 10 years?
So if you're looking at the bigger deals, there's certainly higher correlation. I think that's been proven and continues to be so. And because of that, that's why I look at, and that's why I consider it leverage beta, because the correlation is much more similar than it used to be, and the valuations of that. And therefore, that's why I think it's important in a portfolio makeup when you're creating a portfolio to recognize that increased correlation. And if you're going for more alpha, you need to start investing some uncorrelated assets in the private markets. So for sure, I agree with your comment.
I'm not sure what the question was, but I did want to talk about evergreen funds for a second. And I don't mean this as an insult to the many people that are here from larger banks, investment banks, but I think this is a nightmare. I'm on 3 public investment committees, and you can't stop bankers from talking about evergreen funds as a quote solution to illiquidity. And what will happen is when there is a market break, they will gate. Because on page 172 in footnote 4 of that PPM, which I drafted many years ago, there's the right to gate in an unusual market event. And they will find an unusual market event. And you're suing them to say it wasn't an unusual market event is a futile effort. So I think evergreen funds are chimerical. They're not going to provide the liquidity that people think. And so on my investment committees, people are sold. They're in PE that was bought 5 years before they came on the committee. It is nowhere near liquid. And they're selling some of this stuff to secondary funds, and they're keeping stuff in a side pocket. And the way to solve all this is evergreen funds. Who's going to value 30 private companies in a large Blackstone fund every quarter? I want to meet that person because I don't believe it's possible. What I do for a living is I sue people who commit fraud, in almost every case involves level 3 assets. And all of those are level 3 assets because you can't really value them. They have the value that you get when you sell them in the public or private market, and until then, it's speculative. So believing that you can turn illiquid private deals into firm pricing is the myth behind evergreen funds. On the other hand, clearly, private deals are trading at higher multiples than they did when I started business school. And that's because there is more liquidity in the secondary market, and there's more capital in the market that are buying those deals. But I don't think that solves the problem of quarterly valuations that is going to be ever present in evergreen funds.
So we have a question right here, then we'll move it over.
So I see most people who have capital are surrounded by people like me looking for capital. I'd be curious how each of you source your deals and what rules that you apply to it. And I guess Sal does both real estate and venture capital. I'd be curious for both of those.
Yeah, that's a good question. In venture, we have two rules, and that's mostly run by my partner Albert Ewan, who managed $6 billion for the Rockefeller family in 1926. And so when we look at these opportunities, we're not Shark Tank. We're not, providing tuition. We do not deal with first-time founders. We like founders that have had multiple exits, that they were actually a part of in the lab, not something that they were, they caught a breeze on the way to an IPO at some point in the late 90s because they were maybe on a management team or not. The second thing that we like to do is we like to make sure that we're led by in-kind family offices, which means if it's a life science company, we don't want a real estate family leading the investment. We want families who are patient, who understand the business, who can add not just reputational, not just financial capital, but also reputational capital. And that has really helped us weather and given us a few exits over the past 10 years because of that fact. And how we source these deals is really through relationships and through our reputation in the industry. We are not a fund, we don't invest in funds, we make private direct investments, but we like to believe that, we're sort of much more agile, mice go where elephants can't, and that's why we get to be involved in certain circumstances where maybe a family might have dropped out, didn't make the capital commitment or whatever, we're able to come in, and that's how we've gotten into a lot of deals like AI Scout, we've gotten into, we made a reputation for ourselves that we were able to get into SpaceX and Stripe and some other things as well. With real estate, I have 3 rules because that's sort of like my core business. And before we allocate to anyone, I want to see that they've been through at least 2 down cycles. All right, 2008 was one, the late 90s was really, where it starts. I want to see some gray hair. This one hasn't really started or ended yet, depending on who you ask on this panel. So, we don't really count that. Number 2, I want an audited track record. Your track record is so great, you should have it audited. And a lot of these multifamily syndicators that are coming of age in their 30s were in high school during the great financial crisis, so they don't have any audited financials. And number 3 is really where the sleight of hand happens, and that's what I call a meaningful sponsorship co-invest. 5% is cute, but we all know the game with that. They, manager basically recycles his fees into it. We don't really like that too much. 10% is thoughtful. Anything more shows conviction. Even at 10%, if the family's like sort of, contributing the land at basis they got it at or something, that's additional structure we can work with. And that's really, kept us very successful. We have a very successful Class A industrial portfolio. We did with a family office in Southern California. It's in Nevada. Our investors have been in it. They'll probably be paid off in the next 12 months, the way things have been going with that. So we're very proud of it with, 27% IRR, and it's only been up and running for about 4 years. Thank you.
So just to answer your question, and before that, I just want to say something about the evergreen. I agree completely with you. I was looking through I'm not a lawyer, but I have a bit of experience as well. I was looking at, is this going to be a liquidity solution or a problem? So if you look at these evergreen, usually gated at 5%. So when the proverbial X hits the fan, guess what's going to happen? So then you have to compare, if it's a 4 or 5 year hold, what are you comparing it against? It's not a cash alternative, you're then comparing it to venture capital fund, private equity funds. So I think we all have to be very careful with the evergreens. It's a great marketing tool. In terms of sourcing deals, well, Tom, we sourced your deal 6 years ago because I was a member of the San Francisco Life Science Angel Group. So that's one source. We source deals also with other family offices. We're very active. I probably spend 40% of my day talking to other fellow family offices. throughout the world, talking about deal flow. And number three, we work and get to know usually smaller fund managers very well. And I'm fortunate over those relationships, we co-invested in some very successful companies. And if you treat them very well, usually you get the first call, and therefore you get the opportunity to get in. So it's relationship building. Fortunately, we always use AI, et cetera, as tools, but we cannot replace humans. So I spend a lot of my time traveling, going to family office events. That's one reason why we're here, to meet new people, to see old people, old friends, and it makes a difference. So those things, so when it's smaller, angel groups, family offices, and fund managers.
Ask in the old days, when venture capital first started, the firms did not work together. And then they started acting like clubs or groups. To what extent are family offices working together on deals and sharing deals? I've not seen that much. We have mostly family offices as investors, and I've found it interesting that they don't communicate a lot, but is that changing?
Yes, I do think it's changing. I think a lot of, we're just a single family office, we're not a multi-family office, but obviously multi-family office, I think that's something that my colleague there can address, but I think we've seen that a lot of multi-family offices for sure. Single family offices, there certainly has been an increase, because if you look at it, frankly, the deal size has increased. So what's the Series A these days? It's certainly, you have to put in more capital in the Series A than you did 20 years ago. So usually the single family office probably doesn't have all the money to put in the single family, but if they lead it, when we share deals, and it's reciprocal goodwill, because some charge SPVs, some SPV to charge fees, and I'm not against that, because I look at my net fees. Yeah, I realize I'm not quite as rich as Elon Musk. It's okay, or others. If I'm not number one in the cap table, but I'm getting a good deal, I'll pay fees. I have another fund manager. I don't know why he doesn't. He doesn't charge me fees, success fees, management fee. He likes me. I'm not sure. If I could clone him, I would. And his funds are really good. He's a wonderful person. So we spent a lot of time doing it. So I think because of that, because of the deal size has increased, what is the Series A these days? C plus, seed, etc. That has led to family office having to cooperate because they can't put in the whole round themselves.
Sal, did you have something?
Yeah, I think, one of the things I do before we get into a deal is that I like to ask, who are the other investors? I'd like to, compare notes. That's really started with, the fundamentals of like foundational relationship building. Because, you're in bed with these other investors, what do they like, what they don't like, and it's kind of interesting where the information is readily shared that way. But, getting back to what the gentleman said before, a lot of these family offices now, I don't think, they were at one point be able to serve a check for, and a lot of them still can't do this, but if you look at maybe the NFL as a proxy, these valuations have gotten so high right now that, you need a little more horsepower as it relates to the, being able to take something down like that, even a slug. I mean, these valuations are just going up through the roof, and private equity comes in, families will be priced out of that probably.
Well, there was a panel on sports later today, so perfect. Question?
Yes, Rich, this is for you. This whole field of small modular reactors, right, where they're talking small nuclear fission reaction to deal with the whole energy crisis we have. What is your view on those? Be they both public and or private companies that are emerging in that space?
Yeah, we actually had a presenter at our last Hebrew meeting on that, Stanford graduate.
Yeah.
We're not ready to jump, because it's a capital intensive business.
Yeah.
You have to have more than one to make real money, and it takes time. So we're looking for a bigger player in the space. And we'd rather play it through energy costs going up and take or pay contracts going from 11 to 14% and having a secure 14% than speculating on the smaller reactors. That's our opinion. But we have had, literally last Thursday, a presenter who has 3 smaller reactors, has some funding, is raising capital, but we just didn't get the feel that they have their arms around the space and the capital raise and the time commitment and the relationships with the municipalities and hooking into the system. We've got people who've been doing this for 40 years for energy players, And we're probably gonna stick with them in that regard. I wanted to answer the sourcing question also, and the family office, because it's something we think of. We're 35 family offices. So we've had 800 managers in 15 years. What we see is manager A, who was had an allocation at Millennium, starts his own fund. And then he's 35, and then he starts a bigger fund when he's 42 with 2 other guys. So what we're seeing is repeat business from experienced managers who we've dealt with before. I guess that means we're getting old. And then what we're also seeing is that there's a lot of managers who are raising money over a longer period of time, not 6 months, 18 months. And they're doing their final close, and I mean final. And they're looking for an additional $7 million to close out the deal, and they want it in 2 weeks. So we've tried to become the fast closers, so that a deal, we're looking at a deal right now that Bill Ford is the main investor in, and they had $7 million left, that's why I used that number, and we had a 3-week time horizon. 2 of their deals are about to be sold. So we pay an 8% fee for the time period that we weren't in the fund, and we have 2 deals that we think are doubles. It happens more often than you think. It sounds like magic and free money, but these people have a commitment that they want to raise X dollars, they're looking to raise it, they have the time. So if you have a group of people that can act relatively quickly, that'll happen 2 or 3 times a year. In terms of individual deals, again, I'm a lawyer, so I come at this from a different perspective. There's a ton of work in investing in a round A or round B with 2 or 3 other family offices. You have to hire a real lawyer who does this for a living. You have to go through the documents carefully. You have to go through the science carefully. You need typically somebody who can evaluate that. So unless you're committing a couple $1 million to that deal, it may not be worth the time commitment to do that. So we did think like you that people in my group thought, yeah, I'm gonna hook up with 3 other family offices and we're gonna start doing tech deals. It just didn't happen. On the real estate side, of course, it happens all the time, but the tech side is so much more intensive in terms of the science and the legal side that we just haven't seen it happen that much.
Okay, we have about 5 minutes left, so I'm gonna start here. So 2025 outlook, whether it's sectors, whether it's macro, just thoughts, disciplines, where you see private markets, even best idea, 2025.
So we've, just looking at our recent commitments, I mentioned to the gentleman before that we invest, our latest investment was focused on a fund that's focused on doing the infrastructure play with dementia. That's one that we've done, and obviously that's the fund, and then we do co-investments with most of our fund managers, so we're expecting to have co-investments from that. We also did a climate fund that focused on, this is a European fund, focused on the infrastructure. I think there's a misalignment. You have to see where we're getting private equity-like returns, but we're having infrastructure risk because the assets are a little collateralized. So I look for opportunities, whether it's a deal, whether it's a fund and a co-investment through it, where you get a misalignment in a positive way between returns and reward. The other thing, I'll just mention my dear friend that I would love to clone. I have a very long relationship. It's a technology seed stage fund, the gentleman who doesn't charge me fees. We do a lot of co-investments with him for obvious reasons. We were just at the family office event in San Francisco, Palo Alto. So we will continue to do things that we've been doing, as we've invested in blockchain, we've invested in deep tech, we've invested somewhat in AI. And if you find it's all about the team, it's all about the jockey. Because I don't think the trends are hard to find. It is finding a deal well priced, where you really believe in the management and you have an opportunity to get into those deals. And that's what we continue to do.
Thanks. So I'll end with Richard.
Yeah, I think, again, there's the euphoria that's around tech right now, especially the Magnificent Seven. I think AI, has gotten probably past it's run out of its britches, and it reminds me of sort of the rockiness of the 2001 type of AOL buying Time Warner. It hasn't approached that yet, but the markets will tell us otherwise. But I really think that betting on innovation comes from a 30-mile concentric circle in Palo Alto, where $15 trillion of of wealth is, is stored, is not necessarily a bad bet. I think there's gonna be a lot of innovations, but you gotta be with betting on the jockeys and strong co-investors who are smart and know what they're doing, and they can bring things back into the lane if they sort of go out. So I think technology is, if you look at, how everything's structured in the administration today, it's very pro-tech, very pro-business, very pro, I think, IPO.
Thanks, Richard, we'll close with you.
Yeah, I mean, I mentioned what we're looking at. I do think the Indian market, especially the IPO market, is ripe for outsized returns if you spend the time and get to be a registered investor there. I think the small cap rally has legs. Even for each thing where they were on the don't go down, it's underperformed for almost 15 years. And we're starting to see the movement, but it's not over. I think merger arb picks up. I mean, that's clearly been an emphasis for the Biden administration, preventing vertical integration. This recent the pocketbook deal with Coach and that they blew up, that never would have happened in the Trump administration. That deal would have gone through. They wouldn't have challenged it. Maybe they'll undo it on appeal. I don't know. So I think merger arb, becomes a good space. And power deals, again, yes, maybe small nuclear reactors will happen. I don't think it's 3 years or 5 years. I think it's 10. But take or pay contracts are going to go up. There's going to be a higher premium paid on those deals. And in my opinion, if you can lock in 14% for 10 years with A+ credits, that's the space to be in. Thank you.
Thank you, panelists. I'm gonna hand it back to Marty.